Hello everyone, thanks for checking out my video. The S&P 500 took a significant hit last Friday as it plunged 2%, clocking one of its worst days in the last 2 years. The sell-off was mainly driven by the Magnificent 7 stocks as investors rushed to the exits, spooked by the usual culprits: rising inflation, tariff uncertainties, and a potential slowing economy. Google dropped 4.9%, Meta and Amazon each lost 4.3%, Tesla declined 3.5%, and the rest of the Mag 7 stocks also experienced losses. As a result, the S&P 500 ended last week down for the 5th time in the last 6 weeks. Consumer sentiment is definitely worsening now, and the same can be said for investors. As we head into the so-called Liberation Day on 2nd April, investors are hoping for some clarity. So what can we expect from the tariff front? Let's dive into the video and discuss more. As always, do watch till the end, alright? As shared, US stock markets sold off sharply last Friday, pressured by growing uncertainty on US trade policy, sticky inflation, lower consumer sentiment, and potential slowing economic growth. Let's very quickly break down the few catalysts that contributed to the sell-off last week. The rollercoaster week started on a high note as Wall Street thought that President Trump would narrow his tariff plans. But then, Trump being Trump, he abruptly announced on Wednesday that a 25% tariff will be imposed on foreign cars. That was when the market started its decline for the week. The market then continued to slide on Thursday as President Trump made some hawkish comments by saying that he could place larger tariffs on the European Union and Canada if they both work together to do economic harm to the USA. Then finally on Friday, the Fed's preferred inflation data, PCE index, came in hotter than expected. The reading showed a rise of 2.8% in February and a 0.4% increase for the month. The market expectations were 2.7% and 0.3% respectively. This sparked concerns about persistent and sticky inflation. Meanwhile, US consumer sentiment in March plunged to its lowest level since November 2022. The latest reading from the University of Michigan came in at 57, a decline from 64.7 in the previous month. Consumers are worried about the broader economy, inflation, and the labor market. It's also worth noting that Lululemon, following FedEx and Nike, is the latest company to voice concerns about the broader economy. The company mentioned that the current macroeconomic conditions have led to more cautious consumers. With inflation and economic worries on the rise, consumers are spending less. Naturally, investors were not happy with the comments and market outlook, and the stock plummeted 14% last Friday alone. Alright, looking ahead, we have a huge week as we approach 2nd April, which what Trump termed it as Liberation Day. While the day was initially viewed as a date that sweeping global tariffs might take effect, the details of which goods or countries will be subject to tariffs via Liberation Day remain fluid, given how fickle-minded President Trump is. On the very same day, investors of Tesla might also want to keep a lookout on the company's Q1 delivery numbers. This report is a key metric for Tesla and a crucial test of CEO Elon Musk's assurance that the company's vehicle business will return to growth this year. Not to forget, he recently told Tesla employees to hold on to their stock. Let's see if that confidence can be reflected in the latest numbers, or is it gonna take more time to play out? Meanwhile, in case you don't know, Tesla's share price can move quite violently after the delivery numbers are out. Therefore, short-term traders might want to take note, and inexperienced traders might want to stay out. Speaking of Tesla and automakers, on 3rd April Thursday, the 25% tariff will take effect. This will likely contribute to the volatility of Tesla's share price and also other automobile companies. Okay, the grand data of the week is none other than the monthly jobs report. We already had a poor report last week from inflation. Just imagine we have a weak jobs report. The market might not like it. Just to share, Wall Street might also be keen on how much light the new jobs data will shed on the effort led by Elon Musk to reduce the federal government workforce. And oh, not to forget, on Friday, we also have Fed Chairman Jerome Powell speaking about the economic outlook. His words will very likely add on to the market volatility. Last of all, on Saturday 5th April, it is the deadline for ByteDance to find a non-Chinese buyer for TikTok or face a US ban on national security grounds. The news could affect social media stocks like Meta, Snap, and Google. Let's now move over to the technical analysis segment. Pay very special attention to SPY chart this week because it represents the broader market and also because it has displayed 3 strong bearish signals. Okay, the first one is on the weekly chart. We had a bearish engulfing candle formed at the end of last week, and that's pretty bearish. Secondly, let's check out the daily chart. Basically, SPY got rejected by the 200 moving average. It actually went above it for 2 days but couldn't hold it and fell back down. A rejection at 200 moving average is always very bearish. The third bearish signal is this bear flag that I covered in my last video. That Friday's candlestick seems to show that it is breaking down from the bear flag. If this pattern is confirmed, I'm not kidding you, the downside could be massive, and I'm talking about low 500 at least. If let's say SPY hit 500 in the next 2 weeks, that's an 18% drop from its peak, which is very close to a market crash, which is defined as 20% of its all-time high. Okay, how do we look for confirmation for a bear flag breakdown? 2 things. First, the MACD obviously has to curl back down to create a bearish cross. Next, it needs to close below the recent low of 548. If SPY does these 2 things, be very careful, we could see more bloodbath. That said, despite the 3 bearish signals, remember we are in the new Trump era, things can change very fast. In order for SPY to invalidate my bearish view and thesis, we need some catalyst on 2nd April to boost the market. If that happens, technical wise it's quite straightforward. SPY needs to go back above the bear flag by reclaiming the first Fibonacci level at 563, but more importantly, close above the 200 moving average. Or maybe I should say close and stay above the 200 moving average for at least a week. Then the boost will have some hope of regaining its bullish momentum. Okay, I will keep this bullish thesis short, and we will discuss more again when SPY goes above this 200 moving average. Next up, Apple. Just like SPY, which was also covered in my last video, there is a bear flag forming on Apple's chart as well. However, Apple's share price has not broken below the bear flag yet, so viewers might want to pay special attention to this pattern for the upcoming week. Well, what exactly do we look out for? First of all, a breakdown means that the share price has to go below the bear flag. But for confirmation, it has to take out the recent low of 208. When that happens, just like SPY, the downside can be massive. I think we can expect Apple to visit low 190s at least. But on the other hand, to invalidate the bearish pattern, the first step that Apple needs to take is to close above the 38.2 Fibonacci level at around 224. This is a level that it tested on 3 trading days last week but got rejected. Therefore, a close above it should temporarily stop its rot. For Apple to regain more bullish momentum, it needs to close above 229. That's where the 250 moving averages as well as the 50% Fibonacci level are. A solid close above 229 is pretty bullish in my opinion. But to be honest with you, with 3 key levels here, I would expect strong resistance, which means sellers could likely step in. Unless of course we have some positive news from Trump and his tariff plans. Moving on, let's have a look at Tesla's chart. Okay, I think it's important to bring out what I have covered in my last video, which are the weekly chart had 2 bullish hammer candlesticks. For confirmation, we need the next weekly to close above the high of the last hammer, which means above 249. And Tesla did that. The price is now at 263. But then I also mentioned that for Tesla to temporarily stop its rot, it needs to at least reclaim the 200 moving average. And guess what? Tesla did test this moving average on 3 occasions last week, but failed to close above the level. This means it is still unable to stop its temporary rot. Just one more thing to add, I also mentioned in my last video that if Tesla gets rejected at either the green resistance zone or the 200 moving average, I do think the share price could drop towards the low 200s range. take a look at where Tesla is now. It is at the green zone and is holding on to it with all its life. With last week's analysis as the base, it makes this week's technical analysis more straightforward. So since Tesla already got rejected by the 200 moving average, the bears only have one more job to do, and that is to bring it below the green zone again and fill the gap between 249 and 256. After filling the gap, that's the crucial bit. We have to see if the share price bounces from here. If it doesn't, I do think we will test the recent low again at 217 at least. On the other hand, if somehow the upcoming delivery numbers surprise the investors in a good way, or 3rd April automobile tariffs plans have positive news for Tesla and the market wants to bring up the share price, then I will expect Tesla to bounce from either the green support zone or the bottom of the gap at 249. Okay, but a short-term rebound is not sufficient to stop its rot. I mean, that was what happened last week. So like I have mentioned, it needs to close above the 200 moving average for at least a week. Then we can say that Tesla has stopped its rot temporarily. Oh, one last thing, similar to Apple and SPY, we have a potential bear flag on Tesla's chart, and the analysis is the same as the former. A breakdown will spell a lot of more downside, while a reclaim of 200 moving average will likely invalidate the bear flag. Jumping over to Google. Wow, Google was the weakest among the Mag 7 stocks last week, I think. It actually displayed quite a number of bearish signals. Let's break them down. First up, it went up to fill the gap between 168 to 170 but got rejected the moment it finished filling the gap at 170. Secondly, it has broken below the green support zone that I drew previously. Not just that, it also created a lower low. And how do we know if the bearish momentum will continue this week? Well, watch that MACD closely. It is about to have a bearish cross. Just to add, it only had a bullish cross for about a week, but clearly this crossover doesn't look sustainable at the moment. The last time we had this weak MACD bullish crossover was in February this year, and the share price plunged after the MACD crossed back down. I'm not saying it will plummet again this time, but if we get a bearish cross this week, I would expect Google to fill that gap between 151 and 152 minimally, which is not too difficult given Google is at 153 now. Perhaps we should be prepared for Google to break below 150 and test that September 2024's low of 147. And when that happens, the bottom gap will likely act as a magnet to pull the share price towards it. The range of that gap is from 142 to 145. It seems like it is a case of one thing leads to another. On the flip side, for Google to stop being a falling knife, obviously it has to get above that green zone, which now acts as a resistance. But going above it only means that the bulls can take a short breather in this downtrend. Personally, I think for bulls to have a heavier sign of relief, it has to start closing above 170, which was last week's high. But at the end of the day, as long as Google is below that 200 moving average, the trend is still bearish. Let's now move over to Meta. Alright, looks like we are back to where we were about 1 week plus ago. Meta has fallen below this green support zone again and is retesting the 200 moving average. It depends on how the broader market moves. If it's bearish, then I guess it is a matter of time that Meta finally goes below the 200 moving average, which sits at 575. As you have seen from the other Mag 7 stocks that I covered, below 200 moving average, it basically opens up more downside for the share price. Just to add, the MACD is about to have a bearish cross. So if we get the combination of a MACD bearish cross and a break below 200 moving average, I do think the downside can be quite a fair bit, probably towards the second green zone, which is in the 540s range. Okay, not offering financial advice, if one can ride the downside from 570s range to 540s range, he or she should be able to earn quite a fair bit of profits. But of course, taking any bearish position will require stop loss to limit the loss. On the other hand, if Meta can somehow and somewhat bounce off the 200 moving average, it could easily go above the green zone in my opinion, something similar to what it did previously. But again, we don't want the kind of pick-a-boo kind of pop. We need it to be more sustainable. In other words, it has to stay above the 23.6 Fibonacci level for at least a week. then we can talk about potentially regaining bullish momentum. Hopping over to Microsoft chart. If you could recall, my last video mentioned that Microsoft looks boring, straightforward and a little weak because it has been moving sideways and lacks strength to go higher. Well, we had a little progress now, just a little. First of all, the share price is still more or less in this consolidation zone, but last Friday's big red candle has brought the share price towards the bottom end of the consolidation zone. And more importantly, Microsoft has lost the critical 385 level once again. For this upcoming week, watch if Microsoft goes below the consolidation zone. If it does, and if MACD has a bearish cross, it means the market makers have chosen their side, which is the downside. That's when I would expect that 161.8 Fibonacci level or 373 to be tested. If that breaks, it's gonna be waterfall time as the share price might hit towards that other consolidation zone, which is in the 360s range. On the other hand, if somehow bulls step in this coming week, then we would want to see Microsoft to bounce off the bottom of the consolidation zone and reclaim 385. When that happens, it means nothing actually, because it is still stuck in this consolidation range, which stretches all the way to 396 where that green line is. In order for the bulls to chill a little bit, Microsoft needs to close above that green line for at least 1 week. Naturally, when that happens, the odds of it going above 400 would be high. Moving over to Nvidia's chart, which I specifically mentioned in my last video that the chart wasn't looking great. I highlighted a few bearish signals and the notable one is the death cross, where the 50 moving average crosses below the 200 moving average. Well, Nvidia fell about 8% after my last video. I hope that can earn me a like button from you, thank you. Anyway, just to be objective again, by reading off the chart, there is no sign of bullish momentum yet. If anything, there could be another bearish signal, which is the MACD. It is about to have a bearish cross. If that happens, I would expect Nvidia to test the recent low of 104 as well as the downtrend channel marked by the 2 red lines. This is where Nvidia has to bounce if the bulls want to regain some momentum, because if Nvidia breaks 104 and falls back into the downtrend channel, it will unlock more downside. That is when I think we could finally see Nvidia trading below 100 again. The last time this happened was during the yen carry trade sell-off back in August 2024. Remember previously I said that I might want to pick up more Nvidia shares only if it falls below 100. Back then it seems impossible, but right now it seems possible. Okay, the last line of defense lies at the green support line, which is around 95. If that breaks, I'm not kidding you, we can say hello to 80s range. Okay, but somehow if Nvidia manages to pick itself up, then we should at least see the share price bouncing off the recent low of 104. But for Nvidia to gain some footing, it needs to go as high as 124 and close above it. I know it does seem like there is some way to go, but that's the reality right now. Let's now check out my options trades, 2 very interesting ones to update this week, and they are all summarized on this page. The first trade is this new covered call on Google, which was sold on 25th March, Tuesday. The strike price is 175 and the contract will expire on 2nd May. If you could recall, in my last video I shared that I got assigned with 100 shares of Google at 175 strike price on 19 March, and I also shared my plan of selling covered call to earn some premiums. But I didn't rush into making that trade right after assignment because I saw that the MACD was about to have a bullish cross and it seemed like Google wanted to bounce off that green support zone. Therefore, I waited and waited patiently. True enough, Google surged the next 4 days, jumping from around 160 to 170, and I guess I was lucky enough to call the top by selling the covered call on Tuesday 25th March, where Google hit its short-term peak at 170. By selling that covered call, I received a juicy premium of $515. And after selling the covered call, which is a slightly bearish move, Google fell the very next day, as well as the next 2 days. And with the share price falling for 3 consecutive days, my trade is now sitting on a decent paper gain of around 73%, which is about $375. Okay, the next trade to update is the one that saw a 2000% swing from loss to profit. It is this cash secure put on Tesla which was sold on 14 February with a strike price of $265. As we are all aware, Tesla has been in this very steep downtrend. At one point, it fell as low as $217, and my contract was so deep in the money such that it was sitting on a paper loss of 2000%. But fortunately, Tesla popped quite a fair bit early last week, which I should have closed my position, but I didn't because I was a little greedy. So I waited till Friday as I thought that there is a chance that the contract might expire worthless. However, the market sold off massively last Friday and my contract was floating between winning and losing positions throughout the entire trading session. At that point, I told myself don't be greedy anymore, just take whatever profit I can and run. And so I closed the position by buying back the contract and earned a tiny little profit of $50 US. Well, it could have been more because towards the end of the closing session, the option contract got cheaper and I could have bought it back at a cheaper rate and increased my profits. But okay, let's not be greedy. In fact, I should be very glad that this whole trade has swung from negative 2000% to a small profit. To be honest, I have never seen such a massive swing in option price for my very own trades before. And so I thought this is very worth sharing with my viewers. Okay, moving on to the final segment, my thoughts on the market for the month ahead. First, it seems like there is never a week that goes by where we do not hear from President Trump and his ongoing tariff trade war. Investors should brace themselves for this to continue into April. Looking ahead to April, I must say there is still plenty of moving parts and a lot of information that could send the markets in various directions. Many investors are hoping that the 2nd April's Liberation Day or the coming days will provide some clarity on tariffs and perhaps even the US economy. But honestly, I'm not too sure about that. I'm not sure if we will get the certainty we are hoping for, especially since no one really knows what's going on in President Trump's mind, given how quickly he has changed his decisions in the past month. So until we get some clarity from President Trump regarding the tariffs and the different trade deals, you don't need a rocket scientist to tell you that we can expect continued volatility in the market. This uncertainty will likely limit any significant upside in the stock market. To put it simply, I don't know if we have already hit the bottom, but I would say the market will stay weak, shaky and choppy with limited upside. We likely won't see all-time highs until the trade war is more or less resolved. Just to add on, the market is also grappling with the potentially damaging toxic combination of rising inflation and a slowing US economy, as consumers and households are hesitant to spend due to the ongoing global trade war. Basically, the market is getting squeezed by both sides, uncertainty around tariffs and a slowing economy. This is why the stock market has struggled so far in 2025, as investors are finding it tough to make sense of Trump's new policies. Even the Fed is taking a wait-and-see approach, and it looks like they still have more waiting to do. All that said, just a reminder that we entered 2025 with an expensive market and high expectations. Now, with the added uncertainty, the market has pulled back as investors have gone risk-off by selling high-growth stocks. Therefore, one shouldn't be too surprised that the market is struggling a little now. During this market pullback, maybe it's time to ask yourself, have you ever felt like you missed the boat on buying good companies at reasonable prices? If you are worried that you have missed your chance to invest, now might be the time to look around. Of course, this isn't financial advice, but there are companies out there whose valuations are looking more attractive now than last year. For example, Nvidia is currently down 28% from its all-time high. Google is on a 25% discount from its peak. Amazon is offering a 20% discount, Apple is on sale for 16%, and Microsoft is down 18%. Okay, once again, I want to emphasize that this is not a financial advice. I'm just using these top 5 US listed companies to show that good companies are on sale. In about 3 to 5 years, if their stock prices go up, don't say you missed the buying opportunity. But of course, prices could still go lower. What I am trying to say is, keep an eye on your watch list during this period. Make a plan, dip your toes in a little if you wish to, buy in tranches, and most importantly, only buy fundamentally strong companies. Okay, my personal opinion is that I still believe US stocks can recover and reverse its course by the end of this year, if not next year. The first year of the Trump administration is expected to be choppy and volatile like this, but things should stabilize later on. And if my view changes or if any major events or catalysts come out that could crash the stock market, I will be sure to update you here. So do stay subscribed for the latest updates. That's all for this video. Don't forget to hit the like button before you leave. Thanks for watching.